All right, folks, welcome to Investing for Beginners podcast. Today we have a really fun show. We have our friends Jeff and Jason from Investing Unscripted joining us again. This is our third time, guys. So you guys are starting to become kind of air quote regulars, which is pretty awesome. So, all right. So I thought we would talk about kind of a wider range of stuff. So we came up with some questions. Basically, Jason told me I had to. So the first question I thought we could talk about is, what are your thoughts about evolving as an investor?
Jeff, you want to start there?
Yeah. We actually just did an episode about this not too long ago, and we joked on it. We've been doing the podcast for about, I guess, 2.5 years now, and it feels like it's mostly financial therapy for me, as I started buying individual stocks only in early 2020. I've been investing in index funds in my retirement account for 25 years since I've been an adult with a job, but it was only in the last 4 or 5 years that I've gotten really interested in it. So for me, it's been just this wild ride of a learning experience. If you think about where the market was when I bought my first individual stock in mid-February of 2020, it was an interesting time to start learning how the stock market works, because when I was still in that fascination phase, checking my brokerage account app every 10 minutes, trying to learn how this all worked. Before long, we're in a pandemic, and it's the quickest 30% drop in market history, and then it comes roaring back, and meme stocks and NFTs, right? Like all this craziness just in the span of 4 years, and we have a long bear market, and now it's starting to feel like 2021 again in the last couple of weeks. So I've had to evolve by just the fact that I was so new during such a volatile time. I made so many dumb decisions when I was just starting out and buying things and paying way too much, not understanding, and then having to navigate a long drawdown. So, I think while my learning experience and evolution has come in a relatively short amount of time, and if you think about a lifetime of investing,
you've gotten basically a decades of experience in the past 4 years.
Yeah. But I think everyone has to go through that at some point. If you start investing in individual stocks or investing generally, even in index funds, at some point you're going to hit a long bear market. At some point there's going to be a big bull market, and you have to learn how to navigate those. And if you are picking individual stocks, you have to evolve and figure out how much you're going to buy and when are you going to buy it. And are you more of a dollar cost averager? Are you more of a just make a decision and put a lot of money down and stick with it kind of a person? So happy to talk more about it. I want to give Jason a chance to chime in, but for me, it's just been like a nonstop learning experience, and I've had the opportunity to talk about it on our podcast for the last 2.5 years.
Before I weigh in, Jeff, I'm going to ask you a question. This is a question I don't think I've even asked you on our podcast, but I'm curious. What do you think? And you might need to think about this one. You might know immediately, but you might need to think about it while I wax poetic. If you're going to say there was a single thing that you've learned in the past 4 years that is the most important thing that's going to matter the most to your investing success going forward, what is that one thing?
Probably that you shouldn't be entirely afraid of high valuations, but at some point price does matter. I think that's the biggest lesson I learned.
Yeah.
Because, and it's ironic because I've talked about this on the podcast a lot. I don't know if I talked about it here, but I have a family member who got scared out of the stock market because she bought Cisco in 1999 at literally the very, very top of the peak. And it's nowhere near that price now, 30 years later. So I did a lot of I made that same mistake with a bunch of different stocks all throughout 2021 and 2020. But
you learned the lesson and you kept buying.
Right.
Better valuations too.
But I was going to say, like, the other half of that is I've paid expensive valuations for stocks that have turned out really well, and I think will continue to. So,
right.
I don't think you have to be a value investor. That's the only way to make money, although a lot of people do make money that way. So you have to sort of, valuation is an art as much as it is a science. But that's definitely, I think, the number one lesson is at some point, especially with like larger, more mature businesses, you really have to be careful what price you pay. And then I guess tied to that, if I could pick a second one, it's be ready for the drawdown, right? And there will be one inevitably. And that's the feeling. I remember during that long 2020 drawdown, this constant like, oh man, this would be a great time to have a lot of cash, everything's on sale. And I didn't, because I'm mostly fully invested. So I think those kind of two things go hand in hand. Those are the lessons I learned. What about you guys? Let me turn Jason's question back on everyone else. When you were new or newer, was there like a singular event that you guys can call back to?
Putting us on the spot, huh? What about you, Dave?
Yeah, I would probably echo roughly the same thing that Jeff was saying is that, yeah, when I first got involved investing, I was following the advice of another service. And the first two companies I bought were Microsoft and Activision. And both of them went up and to the right pretty much immediately. The next two companies I bought were Sierra Wireless and Westport Chemical or something like that. Yes, yeah, exactly.
Yeah.
Complete and utter dogs. And so the first 2 or 3 months, I thought, geez, this investing thing is super easy. Why does everybody think this is so hard? And then I bought the other ones and I discovered exactly why it's so hard. And I remember thinking to myself, I need to learn more about this stuff because I really didn't know what I was doing. I had no idea why I was buying these companies, why they're going down, why something was going up. I know you don't always have all the answers, but sometimes you can get a pretty good guess, when the company's revenues are tanking big time and maybe the product they're making is not as popular as everybody thinks it's going to be, they tend to has an impact on your investment. So I learned very quickly, I got to learn my stuff. And so that's actually when I discovered Andrew, among other people, and started really digging into Buffett and, the financials and fundamentals and trying to start to learn the art of valuation and discover the idea that price does matter. And I do need to pay attention to some of those things. And yeah, that was it for me.
Yeah.
Andrew?
I was on the flip side of that. I learned what happens when you take price too seriously, and it took me a much longer time to do that. So in 2020, when I expected to do better as a value investor, because that was when the market was finally crashing. So that's supposed to be the day of the value investor. And my portfolio was not reflecting that. I was like, okay, I'm doing this value investing thing wrong. And a lot of it has been too much focus on the numbers, too much buying stuff because it's cheap. And so I've had to learn kind of the reverse side of that, of like, okay, to Jeff's point, valuation does matter for a lot of businesses, but for a lot of other ones, it doesn't. It's definitely an art, and you have to figure out that balance.
Yeah, so much to take away there from me, and thinking back through my 16 or 17 years at this point of actively picking stocks and investing and managing my family's almost all of our invested assets for most of that period and watching it grow. One thing you were talking about, Jeff, was being ready for the next downturn. And I think the biggest evolution, maybe the most evolution that I've had, is how that simple phrase can mean something incredibly different to different people at different places in their life, right? So most of my investing career, and still now, largely being ready for the next downturn means having dry powder, means being ready to put that cash to work. Or maybe I have some money in an index fund and I sell the index fund when it's down 20% and buy my favorite 3 stocks that are down more, that I know are getting hit hard right now and they're going to bounce back. But what I've also come to realize as I'm getting closer to certain financial goals, like I can actually look at our portfolio now and do really easy math and know the rates of return that we need over the next 10 to 15 years to pay for our kids' college, retire early if we choose to, like those big milestone moments in life that like we're investing for. And like, I know like the thresholds that I need to get there. And I now understand how a big protracted downturn is maybe as unlikely as it might be to have like the global financial crisis sort of thing happen again. But if that happened right now, it would derail my retirement, right? It would derail my retirement if I didn't make certain changes, like going to more fixed income that I've started to do lately and thinking about expanding that over time. Because we're talking like that, for example, is a 5.5-year period where the market, from top to top to fully recover versus the 9 months that we saw back in 2020, right? So evolving as an investor based on my goals is probably the biggest thing that's changed for me that I think is the most important thing that's changed. Thinking about valuation, like I used to be I would do the dumbest stuff where I would just buy a stock based on a recommendation in a newsletter and not think twice about looking at any valuation. But then I would be thinking about a stock that I found that I wanted to buy. And I would get so hung up, Andrew, like you were talking about, in the multiple. And this is really cheap. Why is it not going up? So when it comes to valuation, something that I've learned a tremendous amount about, I still screw it up all the time, but why is something valued the way that it's valued? Just because it's cheap doesn't mean it's ever going to be not cheap, right? Those value traps that we fall for that are just so attractive. And just because it's expensive doesn't mean that it's ever going to not be expensive too, right? Looking at stocks that MasterCard and Visa's example, they always trade for really high multiples because they're just such cash efficient businesses and they're so profitable, they earn that higher multiple, right? So understanding the why behind valuation has really helped me make better decisions when I'm thinking about a stock, I'm thinking about it versus growth versus maybe a large mature business that's ballast and dividend growth and that kind of thing, where paying a better valuation maybe matters more versus trying to get a perfect price for a company with a massive TAM and it's still small and it's really just starting to kind of lever into that cash flow profitability, like the crowd strikes, like we've talked about that one before with you before, Dave. Understanding the why behind valuations to appropriately price stocks based on what you think it's going to do in your portfolio has really paid off.
Does portfolio management play into that also? Talking about, I'm just thinking of Brian Feraldi's chart. I don't know if you guys follow him. He has like a life cycle chart where he shows beginning phase, growth phase, and then there's that operating leverage phase where you're starting to go from not quite profitable to now they're starting to get that profitability.
Yeah.
So I'm curious, like what your portfolio strategy is for those type of stocks, or is it completely independent of, like, is it based on your conviction or is it based on like the stage that it's in?
It's a little bit of both for me. Jeff, I want to hear you talk about this too, but for me, it's, my portfolio as I've evolved as an investor, I spent the better part of the first 10 years of my career. But my goal was just to buy stocks that were going to beat the market, which is sure, that's a great approach if you can be mindful about it and not over leverage to YOLO bets. Those ones that you think are going to get profitable and they never do, right? As my portfolio has gotten bigger, I have leaned more towards kind of a barbell approach. So on one end, I have my dividend stocks that are stable, more predictable, like easier to evaluate and value businesses. Those I tend to just buy a half or a full position pretty quickly and I own it. But thinking about like that life cycle of from startup to IPO, burning cash, trying to build leverage, to making that transition, I almost always start small in those. And those businesses have to earn my capital, not by the stock going down and me deciding to buy more, but because hopefully the stock is going up because the trajectory of like cash flows, like that's operating cash flow. Like I started gross margin and then look at operating cash flow. And generally it's a burn. And if gross margin's holding firm or even expanding, hey, this is really good. And that operating cash metric is moving closer and closer to break even. And then all of a sudden that gets positive. So like looking for that trend to continue. And with a lot of these companies, Andrew, because so many startups generally nowadays, the most successful ones are technology companies, you've got dilution that's part of it too. So you have to look at those metrics on a per share basis too. Block is a good example of a company that has grown a massive amount over the past 5 years, but none of it's carried over to shareholders because executive compensation, right? New stock. So thinking about those things on a per share basis and letting the companies earn more of my capital by steadily improving their performance and the things that are in the thesis actually playing out. So that's really what I look for. Jeff?
Yeah, I'm in a little bit of a different boat because I don't know the exact amount right now, but I own only about somewhere between 10 and 15% of my total invested wealth is in individual stocks, just because I got such a late start at it compared to index fund investing. And my wife has always just done index funds in her side of the account too. So like, it's not that much of I joke all the time, like my stock portfolio could go to zero and it would suck, but like it wouldn't crush me because it's still only like 10-12% of my overall portfolio. I actually probably should be a little bit more aggressive with my individual stocks, if I'm being honest, just because but I look at it as my stock portfolio is just a fun learning experience for me. It's really everything else that's going to get me to retirement, unless I get lucky and, stumble upon a 10 bagger that 10Xs in the next 10 years, right? Like then maybe that changes the calculus a little bit. For me, I think about it, I guess I do think about the life cycle. Jason said it about going slow with those earlier stage businesses. I do the same thing. There's stocks I own where I like them and I think they're going to be good investments, but I'm looking at them on like a 10 plus year horizon. Like Lemonade is a good example. I like the story. I like what they're trying to do. I like how they're trying to change how people view insurance. I like their strategy of, kind of grabbing younger people who need insurance and making them realize like, oh, this can actually not be like going to the dentist and having a cavity filled every time I have to file a claim. But they're still struggling with profitability and cash flow issues and all that kind of stuff. And I'm fine with that. I haven't added to it much recently. I might add a little bit here and there over the next couple of years. But if that turns into a great investment 8 years from now, that's fine with me. That's sort of what I'm expecting. So I add to it periodically, but nothing crazy. Whereas like if I feel like ASML, another company that I own that I have a lot of conviction in, if I see that at what I believe is a compelling price, I'll spend a lot more on that because it's established, right? It has a long track record. It's, there's still going to be volatility and it's still got risks like any stock does, but totally different boat than something like Lemonade, which is still at the beginning of its life cycle. So I don't think of it so much through the specifics that are in that chart that you reference. I know what you're talking about. I've seen that before that Brian has put out, but I do think about it in terms of, if I buy one or two things a month, I'm thinking about where to put that money, how much of the money to put in. I definitely take that into consideration.
Jeff, as your investing therapist, and I'm not breaking patient confidentiality because all of our sessions are in the public domain.
That's right. Yeah, it's public therapy for me. It's not private.
I do want to observe that one of the things that I've seen you do is, as you've kind of come to the full reality that it's a double-digit percentage. It's not nothing, but you've come to that full reality that this is a really narrow piece of your wealth. You have started acting with more conviction.
Yeah, I used to buy very regularly, very small amounts.
Yeah.
And it was getting super frustrating because I would, it's like I've been buying this stock. I bought this stock 18 times and it's still 0.03% of my own, it's just like ridiculously slow. But I'm glad I started that way, right? No one likes to lose money. So I was careful. And, the four of us are in the minority, right? We're four people who like to spend time thinking about this stuff. Nobody else in my life other than, well, really you three guys actually spends the time thinking about it. So, we're sort of outliers here, but I'm sure a lot of the listeners are interested in this as well. And to me, if you're constantly learning and evolving and improving, it makes sense to, over time, just be a little bit more confident in the decisions you make.
Yeah.
So I've started to make, talking about how I've evolved anyway, I started to buy less frequently, but when I do, with more money. And I'm starting to see some benefits to that because, if I'm right, like if I decide this stock is undervalued and I buy $10 of it, it could 100x and that's not going to change my life. But if I'm right and I, put a couple thousand into it and it 10x's, that's a whole different story. I think it'll be fun to look back on 2024 in 2028 and see, what's different about how I invest 4 years from now.
It's so cool to hear you talk about the evolution of your portfolio management in that way,
Yeah, I probably spend too much time thinking about this kind of stuff, but hey, that's why we're here.
As long as your therapist says you're not overthinking, then I'm going to say
That's right.
I'm going to trust the therapist.
Yeah, at some point
I will prescribe a new brokerage if you start.
At some point, I haven't done it yet. At some point, I'll go back and listen to some episode from like 2022 and be like, what was I thinking?
Don't do that to yourself. Trust me. As somebody who's done that, don't do that to yourself. It's cringe for
We
sure.
encourage our listeners to go back to listen to back issues, right, Dave?
Several times.
Several times. But as content creators and artists, we're our own worst critics. So then
Yeah.
you go back and listen to something you said 2 years ago and it's like, oof.
Yeah. Well, but I think, that's what I love about these conversations. Like, obviously this is a lot of what we do on our podcast. And when you guys have us on, you've been so generous to have us on some, a couple times now. And I love when we get together, the four of us, because I don't think there's enough people in this little investing media creation world who are willing to talk about mistakes and insecurities and how they've evolved. So much of what's out there is, this is my 40-page research paper, buy this stock, or, tweets about, with screenshots of their NVIDIA shares that are up 700%.
Right.
And, fine, but show me the rest.
Right.
Because I know statistically more stocks that you bought are down than up.
Mhm.
I don't mind going back and hearing the stupid things I said, because I think that's, everyone goes through that. And if we can help other people realize like those feelings are normal, then we're going to do good by the people who listen to the shows.
I also do not mind to go back, Jeff, and hear the stupid things that you've said.
Well, the nice thing for me is I don't ever have to go back to hear you say something stupid. I just have to wait a few minutes and something stupid will come.
Jason's going to say something stupid. Market is always forward looking.
Generally, when the mouth is flapping, there's something dumb coming out.
Yes,
Yeah,
basically.
There you go. That's exactly right. Yeah.
So how do you guys think about, we're talking about evolving, and how do you think about, like, do you feel like at a certain point you should stop evolving, or do you think that that's just part of the learning process and you're going to evolve? Like Buffett gets analyzed to death, and there's all this conversation about him changing the way he invested once he kind of became buddies with Charlie. But I feel like over the last 30, 40 years, that really hasn't changed much. And so I guess, what are your kind of thoughts on that?
All right, I'll answer that two ways. I think Buffett has, I said this somewhere else. It might have been on an episode we did, but the thing that most impresses me about Warren Buffett is he has managed to simultaneously remain completely consistent, but while not being resistant to opening his brain to new ideas, right? Like you can argue about who bought Apple and who bought Snowflake and who bought SiriusXM, if it was him or one of his lieutenants. But if you had explained to someone in 1977 what those companies were and said Warren Buffett's going to buy these one day, they would have been like, no, that's not what he does, right? So like he's not been inconsistent. He's followed his style of investing forever, but he has opened his eyes to new ideas, right? So I always am impressed with people who can hold two independent thoughts at the same time. To the question about should it ever, I don't think it should ever stop. I do think it slows down. And I think it actually gets replaced with like just pattern recognition and muscle memory, if that makes any sense. Like, we all have professional backgrounds that at least started, at least my understanding of everyone on this recording here, in some other field, right? Like I know, Dave, you were a music major in college and a musician at one point. Jason was in sales and I'm in education, and Andrew, I actually don't know what you did before all this, but the point, okay. But the point is, like, if like for me, if I think about like in my educational world, there's a lot of stuff that's just second nature to me, right? I see it, I know what it is. It's pattern recognition because I've been doing the same thing in the same profession for 25 years. I would imagine once I'm 25 years into being an active stock picker, it's going to feel the same. I'm going to see something and go, oh, I know what that is. I don't need to spend 7 hours thinking about it. I've seen that 1,000 times before. It's this. And I already start to see like little bits of that, things come across and I'm just like, yep, know what that is, file it away. Whereas like 2 years ago, I would have had to go Google it and read about it and learn. So I think it slows down in that sense that you just sort of innately see and know things the more experience you have, but never stop learning or trying to evolve or change things. But I'm curious, you guys have all of you guys have been buying stocks longer than I have. What about you? Has the rate of change slowed down for you guys?
That's a good question. For me, no, I don't think so. I think, I feel like I go through stages where I learn. The more I learn, the more I'm trying to be open to other ideas, and also just my psychology is that I don't feel like I know enough always, and so I'm always trying to learn something new, and that causes me to continually try to push against my boundaries or my circle of competence, if you will. I may get shiny object syndrome about a company that I may not totally understand, like a CrowdStrike or a Novo Nordisk, for example, but I may not ultimately end up buying them, but I still learn a lot from trying to expand on that circle. And so I guess that for me, it's a constantly evolving thing. And the more I learn, the more I don't really know what I was doing before. So it just kind of confirms that I don't know what I'm doing, or don't know what I know.
To me, that feels like, I feel like there's two aspects of this idea, right? There's the constant expanding of your circle of competence, which I think we all probably are always doing. Mm-hmm. But I think that might be, I'm thinking of it at least a little bit differently than evolving in my process as an investor. You know what I mean? Like, I don't know that I'm going to be seeing as much change in how much I spend when I buy, what I buy, how frequently I buy, how I think about that kind of stuff. Like, I feel like that's what I'm talking about when I say like that rate of change has slowed, and I think will continue to. Yeah. But yeah, I hope I'm the same as you, Dave, forever. Like, this is a new industry. Like, AI is new, right? Newish compared to everything else. Like, I want to learn more about that, and that 10 years from now be some new thing, and we'll all have to learn about that. So yeah, from that aspect of expanding the circle of competence, that probably shouldn't slow down for anybody.
No, I would hope not. But to your point, the process has slowed down, and in part because the more reps I put in, John Rotanti talks to me all the time about reps, and he's referring, of course, to weightlifting, but it applies the same with investing. The more analyzation I do, the more DCFs I do on a company, the easier it is to get. And I don't get as bogged down in the minutia of the numbers, and it's more about just the routine, and you can see things a lot quicker that way.
Yeah.
Andrew, earlier when you were talking about thinking about like my time has come as a kind of dedicated value investor, and to me that feels like what you went through, and this is what I want to talk about, is less changing and more just kind of optimizing.
Maybe. I don't know. I mean, I do feel like I changed after that time. Like, I started to take the finance stuff more seriously, in the sense of, okay, how is Wall Street looking at these? What's a reverse DCF? Like, what are the other factors I'm not thinking of? And then filling in those gaps, filling in those blind spots. For me, the rate of change that Jeff was talking about, I think it's gotten to a point where now I think my circle, as in my comfort zone of the types of stocks I want to buy, I think that's starting to solidify. Like, I like the cash return stage of a business, and I find that my valuation tendencies tend to work better in that space. And so I'm finding that I'm not sure how much more that will change. Maybe it'll start to change, but I'm guessing that based on everything I've had to learn the hard way, that I'll probably be in that general area for most of the time moving forward. And I just hadn't been like explicit about it. So yeah, so that's one side, the rate of change slowing, but on the other side, I have to really be careful about saying no too fast to companies, businesses. Right. I always learn about new businesses, because I feel like there's such a high rate of change in businesses, and we saw so much disruption in the past couple decades. Like, you can't stop flipping the rocks over, otherwise you're going to get left behind. So that's kind of how I look at it.
Yeah, I think Buffett is a good example, but there's a lot more nuance that I don't think enough people really use when it comes to Buffett, because I think the reality is that for the most part, especially early in investors' careers, particularly for people that you don't only do it, maybe a few hours a month, right? It's not something that you really have a lot of spare time to do. I don't think you're changing as an investor. I think you're figuring out who you are as an investor, right? You don't know. And it takes a long time to really like arrive at the investing process and building a framework and the style of investing and what you're looking for. that like fits in your brain space, right? And your, how you're wired when it comes to like your self-discipline and your mindset and all of those things that make us up. I kind of think about it like power, money, alcohol, and investing. These are things that people say, well, man, money changed that, guys. No, it doesn't. It's for that guy, man, he gets drunk and he gets crazy. They amplify parts of our emotions that are already there. And I think the same exact thing happens when we're investing in stocks, because it's our money and money's feelings, and it moves completely outside of our ability to control it, right? So it's going to amplify the best and worst parts of our personalities. So I think there's a lot of time that we spend, and this was certainly true for me, like finally building like an investing life around me, like who I am, and like to tamp down the things that I'm going to screw up, make them really build friction for those things, and try to amplify and accelerate and feed more fuel to the things that I'm good at doing and that I'm good at finding. That's what's happened for me. And I think for Warren Buffett, there's a lot of maybe misconceptions that still hang around. Dave, he's still widely thought of as a value investor. And I think in a lot of ways, that's still probably really true. You mentioned John Rotanti, and John Rotanti's done some really good research into Buffett and talked about like Apple. I think he paid like 13 times cash flow for Apple. So it's not like he was buying it at the 30 times earnings it trades for now. So he's figured out like those timeless things about who he is, and valuation really matters. But he's expanded beyond the buy $1 for 50 cents and then sell it when it gets back close to $1 and move on to find that next dollar for 50 cents, right? So that's a different, that's changed. And also like figuring out how to value things like brand, like how is your brand a moat, right? When is it not a moat? Like finding real durable competitive advantages. And those are like optimizations, I think, to Buffett's style, because things like, the one time, one of his annual letters 35 years ago, he said that the investing world would have been better if somebody had have shot Orville and Wilbur, right? So, and then, in 2019, 2020, he was buying airlines. So the industry changed massively, right? And that mental flexibility of being willing to change your position when the facts change, when the things change around it, that mental flexibility is really, really important. Everybody doesn't have that though, right? So building an investing process around yourself based on what you're good at and to tamp down those things that get in your way, I think that's super important. And I've gotten to the point where my approach is basically my approach. And it's really staying laser focused on my financial goals when they are, and applying the right tools to get me to those goals. At this point, it's very much just kind of an optimization thing, I think.
So for you, Jason, did that realization happen over time? Was there a certain point where you felt like, okay, I'm self-aware and now this is how I'm going to operate? Or like, can you describe that journey?
I was clueless for 6 or 7 years, probably. Not clueless, but it was it was 2007, 2008 when I really started getting interested, and 2009, talking about pretty decent timing. I'm like, okay, I really need to supercharge my investing, and individual stocks are the way to do it. But then 2011, 2012 happened, and the market was sideways, and I couldn't make any good investing decisions for 6 months. So it was really probably that first 3 or 4 years there before I realized I really need to figure out what I'm trying to solve for and understand how to get there and get out of my own way. And it was very incremental after that. But that first 3 or 4 years was the struggle. And then it was really over the next decade where it's just kind of evolved as my portfolio has gotten larger, as I've gotten closer to financial goals, having a kid. Andrew, something, you can relate to that right there. Things that happen that change your approach and change your mentality a little bit. The way that you invest, the way that you think about investing, thinking about downside. I think about downside a hell of a lot more now at 47 than I did at 37,
It's interesting hearing all you guys talk. Like the word that keeps coming into my mind as it relates to evolving as an investor is patience, and the ability to develop that as an investor, and realizing that there's almost nothing you have to immediately react to in the world of investing. Maybe there's those very rare things where all of a sudden a company's insolvent and you might want to sell your shares before they go to absolute zero. Like maybe those things you want to be a little on top of, but generally it's really hard to completely miss something that you've been keeping an eye on. Like the $10 you paid now versus 2 weeks ago is not going to matter in 30 years, that kind of stuff. And I think what's interesting, we're all around the same age, I think, and whether we got started when we were in our 20s or got started 4 years ago, like I did with buying individual stocks, we all had the benefit of age and understanding that, I think it's hard when you're like 21, 22, 19, whatever, when you're just first having a job and investing. It's really hard to fathom that like a couple $100 can turn into tens of thousands of bucks down the road. That's just, you can't, it's really hard to think that way when you're young. And for me, like the patience thing is a byproduct of just being older, but also the fact that because I was an index investor for so long, I can see that over the long term, all this kind of shakes out in the wash, right? Like I remember getting the statement in the mail when I wasn't really paying attention during the great financial crisis and being like, wow, lost a lot of money this quarter, and then just putting it in a drawer and then, a couple years later getting one and being like, oh, wow, look at that. We're back where we were. So I have the benefit of age and hindsight to know that like these things do shake out. It does make me wonder if you're starting right now and you're young, you're young, right? So that's challenge number one for seeing the future. Like no young person sees the future very well. And we're in a completely different world, right? Like immediacy is just expected now. Like none of us need to be old man, raising our fist at the clouds right now, but nothing was immediate when I was 19. It was like totally different world. I think those are some challenges that people face if you're starting now, but I think like honing your patience to me feels like something that would benefit any investor at any stage in their life.
I've got one more thing to add before we move on here. I think one of the most important things that I'm speaking directly to your listeners right now, but I think one of the most important things that investors have to do, you have to evolve, is breaking the bad habits that are common, like rules in investing that are usually BS, that people think are just the things you're supposed to do. Like, you buy a stock and it doubles and you sell half of it and you say, well, it's house money now. No, it was always your money, right? Sometimes, yes, selling half of a winning investment does make sense because you're rebalancing your portfolio or you're concerned about valuation or whatever, right? Sometimes it makes sense, but like always doing it is dumb. This is the one that I hate the most that so many people do, is you have a stock that stinks and you're going to sell it, but you're going to sell it when you get back to break even. Bro, you said it sucks. What makes you think it's going to go up, right? So breaking those sorts of habits and those like mental gymnastics that we put ourselves through that are not in our best interest. I want to give an example on that second one. So like SolarEdge, it's a company here that makes electronics for solar panels. Residential solar is a mess right now. Everybody's convinced that the Trump administration is going to rip all of the incentives out, so that industry is down. But SolarEdge is like, they're in a real mess. But at one point, the stock was up, I don't know, 300% in a few years. Massive, massive gains. A colleague of mine bought it and owned it. I owned it too. I sold a while back. But he held it through like earlier this year. And he sold it down, little. It was down from where he bought it. When he sold it, it was down about 75% from the high. There's a lot of people that are like, oh, it's going to come back. I'm just going to hold it. It's fallen another 70% since he sold it, right? Don't hold stocks that you hate because you want them to go back up. They won't. Okay, I'm off the soapbox.
Good soapbox.
But Jason, that means if I sell the loss, that means I made a mistake.
Bingo. That's exactly right. That's exactly right. You already made the mistake, right? You're exactly right. That getting over that mental hurdle, it's Buffett's first rule, right? Don't lose money. Second rule, see number one. Think about it in the aggregate.
That's the piece I want to jump in on, because the thing I learned is it's hard to do when you're like super interested in this and like you can spend hours thinking about like one individual stock. And then when you take a step back, that one stock you're thinking about could be 0.5% of your invested wealth.
Yeah.
But you're spending 6 hours, deciding to buy, sell, or hold, right?
That's exactly why my colleague said he sold it. He said it was a tiny fraction of his portfolio, but it was taking up an outsized percentage of the time that he thought about his investments.
But yeah, but like to your point, Andrew, about like, but selling means I admitted a mistake. This is where understanding how this all works really helps, right? Because like you cannot do this without making a mistake. It is impossible. The best investors in the world are wrong more than half the time. So like the phrase that I like is look at the bottom of the brokerage statement, look at the total, totals line.
Yeah.
Whenever I open up my spreadsheet, it's just a habit I've developed because of this. I look at that bottom percentage first because it's a good reminder that like I might spend 6 hours worrying about my NVIDIA position, but if I look at the bottom, my whole portfolio is up X percent, and that X percent is good. And mixed in there are big winners and big losers. This is not any kind of weird humble brag. I bought it not knowing what the hell I was doing, and I spent just a couple $100. So, but I do own NVIDIA, and it's up like 700%. That's awesome. That has covered like 7 or 8 other stocks that are down 60, 70% plus. I have one that's down 90 something percent. And I could lose a lot of sleep worrying about any one of those individual ones. But again, when I look at that bottom line number, the whole portfolio is where I want it to be. And that's what you have to understand, which is why you should have a diversified portfolio and own a bunch of stocks and not just 3 or 1 in the case of my family member with Cisco. I think that's the thing. Like you have to learn enough. You have to learn enough to know that that's what you should worry about. Like, what is your goal? What are you saving and investing for? Or what are your goals, right? Could be more than one. And every once in a while, you just got to like get your head, bring it up into the clouds, right? And look at it from a high altitude and not from the ground level.
Mm-hmm. Very well said.
Yep, exactly. I know Andrew and I, when we talk about stocks weekly, there are days that he and I will talk about companies that are a very, very small portion of his portfolio, and maybe they aren't doing as well as we all would like. And we obsess about why, this company that's a very small percentage is really not doing as well as we think. In hindsight, maybe it would be time better spent to focus on other things, but it's hard to do because it's not doing as well. And so it's a mistake. And so it's like anything else. You look at your fantasy football team and you see one of your wide receivers is underperforming, and you obsess about that particular person, that performance, and you ignore, the Super Bowl team that you have everywhere else. So it's a really hard thing to get over.
And I think it's okay to spend some time like really deeply thinking about why something possibly went wrong, because you want to.
But you have to not be myopic about it, right? You have to be using that for the lessons that can help you everywhere else.
Yes. Well, for me, it's 2 things. It's, you hear the stories about the stock that, is a big winner, but had 6 70 plus drawdowns over the course of its history. Like the one I always remember is like there was a one point where Amazon had lost 90% of its, or been down 90% from a recent high or something like that, and here it is now, one of the biggest winning stocks of all time. And so even something that's super beat down, I think it's worth looking at because maybe it is just a really bad time and they're going to be fine. I mean, does that happen to many stocks? Probably not. But the other piece of it too, like you were saying, Jason, is like, what's the lesson to learn? Right. Like the stock I referenced a few minutes ago that was down 90+% in my portfolio is Outset Medical, which if anyone listening to this who's a listener of our podcast is probably playing their drinking game right now because I talk about it all the time. But it's such a great example of me getting caught up in the story.
Yeah.
And that letting the story, because I really want this company to succeed. They make a home dialysis machine for people who need kidney dialysis, and it allows them to not be in a hospital 4 times a week for 6 hours each time. It's great. I want them to be a big winner. I want everyone to get dialysis this way. I think they're amazing and wonderful. It's been a terrible investment for me, but I still obsess over it and I want to see if it'll turn things around. I haven't sold it, but the lesson I learned was just because you think the story is great, don't let that be the thing that blinds you to some other issues, right? Like if I was starting that all over again, probably should have sold it like a year and a half, 2 years ago when I started to see some of the troubles, Yeah, I think as long as you're spending the time obsessing about it, but taking the lessons from it, I think it could be time well spent.
I would wholeheartedly agree. I know that I have spent a lot of time thinking about companies I missed on. Like, why did I miss on these? And why am I still not buying them? And those are the lessons that I know that I'm still working on trying to learn.
So can I build on that and ask you guys a question? Because this is something we were talking about this a little while ago. Have you found you guys, have you found that you're less likely to buy new stocks as you've grown as investors? Like when I started out, I wanted to buy everything. Like I went from no stocks to 120 stocks in like 3 months. Everything was like $50, $10, $13. I mean, it was like stupid tiny amounts of money. But I was just at that stage where like, that looks cool. I want to buy that. Oh, that looks neat. I want to buy that. And now if I buy one new stock a year, I feel like that's crazy, you know? So I'm curious for you guys, like, has that pace slowed down for you? Are you much more picky about new investments, or do you guys buy a bunch of tiny little starter positions and kind of learn that way?
Yes and no for me. When I'm making a position with size, then I'm very picky on that. But I like to have a lot of like a farm system, like a lot of my prospects out there.
Yeah.
So I'm yes and no on that. What about you, Dave?
I'm probably more like what Jeff is talking about. I tend to be a lot pickier about new companies. And in part, it's not because I don't want to add new shiny objects to the portfolio. It's more about, I have about 22 companies now in my portfolio. And I worry that if I get a lot more than that, it'll be really hard for me to manage, like how to keep on top of what's going on with all the companies. Like there's some, for example, like Visa, I don't really need to dive into every minute detail of what's going on with Visa because I know it so well. But other ones that may be newer to me, Starbucks, for example, is newer to me. I don't feel like I know that one as well. So I gotta obsess about that more. And so I tend to look more within the portfolio for reinvestment ideas than newer ideas. But that also kind of feeds into my personality too. I like the team that I've built, and I tend to focus on the team I've built and not really look to bring in, another star pitcher kind of thing as much.
I want to share something here.
Uh-oh.
This is a safe space. It's just the four of us.
No judgments.
Well, no, it needs to be a safe space for somebody else. But I'm going on a bit of a tangent back to that stories you're talking about Outset Medical. And I want to circle back around to lessons for investors and needing to evolve. Some of the most optimistic, best storytelling CEOs oversee some of the absolute worst businesses you could possibly invest in. I want to give an example that I think may be the worst. I'm only going to be using facts. So no slander here. It's all facts. There's a stock that one number since the current CEO took over in April of 2008. This number is up 9,870%. So it's pretty great number. There's another number that's down 93.5%. Now there's two numbers. One is shares outstanding. One is the stock price.
I know which is which.
So this is Plug Power. They've increased their share count almost 10,000%.
Oh my
Goodness.
And the stock is down 94% since Andy Marsh took over. Is one of the most optimistic, best storytelling CEOs in the business, and has done an incredible job of selling a story that their best business is selling a story, doing secondaries, selling stock to new bag holders. That's their business, right? So those stories are so dangerous.
Yeah. And that's a lesson that you'd hope investors who've made that decision with that company or any other company have learned, but there's always new people.
The most vigorous defenders holding their bags. It's remarkable. Yeah.
I mean, that could be a whole nother podcast because I've thought about this a lot, like what CEOs get to that role partially because they're great storytellers. It's just part of the skill set you have to have.
It's the number one job is to market the business.
And the ones that are really good at it are probably pulling something over on you. And even the most cynical person might miss it. Right. So it's tricky. It'd be a fun one to talk through.
It's like Andrew said, then admitting you're wrong. Right.
Mm-hmm.
Yeah.
No, now it's on sale.
Yeah.
Oh boy. Yeah. We've done some videos on our YouTube channel. The mistake I've made was engaging in the comments.
Oh man.
Yeah, there's some
Well, I
defenders.
imagine they would have the fiercest defenders then.
Oh,
Like a story like that, right?
staunch defenders. Yeah.
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 Mm.
Yeah. Absolutely.
I have said some things about Jack Dorsey and Square.
Oh, same.
You know, he is, to me, that he's kind of another good personification of what you're talking about. He obviously tells a really good story because he's an amazing creator. He creates these fantastic products, but if you look at his track record at Twitter and at Square in charge,
Doesn't
it's been
create
horrible.
value. Yeah.
It's been horrible.
He's a great storyteller, but I think he's a bit of a visionary,
Mhm.
way too distracted, and has never had the people around him to rein those things in and focus it where it needs to be focused.
Mhm.
Yeah.
I agree. You know, I remember when I was working in the bank, seeing those little Square dongles and thinking, oh my God, this is brilliant.
Yeah.
And now if you look at kind of across the landscape of kind of what Square does, they've lost the
No
lead.
edge.
Yeah. They're, you know,
No moat.
Clover's killing them, Ajin's killing them, you know, just across the board, all these companies have just come out of nowhere and passed them. And I don't know if they could ever catch up again.
Yeah.
It's interesting because there's a lot of people who are really big on founder CEOs and founder-led companies, and I understand why. There's actual statistics out there that show that those companies tend to do well. But it's a double-edged sword because I do think the opposite can be true for a company where the skills to get the company started and get it to a certain point are not the same skills to get it past that point. So a visionary CEO can be the whole reason a company has gotten to this particular point, but also the reason it's not going to get any further. And I do wonder if some of the folks we're talking about are in that category.
Mm-hmm.
So just to speculate then, do you think when Tesla stock went up after the election, do you think that was because investors were like, all right, Elon's not going to be involved in Tesla anymore, and somebody else can kind of be the capital allocator there?
I don't think that's what that's what did it. No,
I have no idea. I don't own the company or anything. So
the reason
I think it's he has the president's ear, and that's going to be the rocket fuel there. And this is actually a really good example of like the challenges of being an investor and the mental gymnastics that we put ourselves through. At the same time, Tesla stock skyrocketed. Musk's proximity to the new administration, potential role in it, all of those sorts of things. Bank stocks were skyrocketing. Well, guess what? Because they're probably going to have less regulatory thresholds, all that kind of stuff. All the renewable stuff was getting absolutely smashed. Elon Musk's biggest wealth generator, Tesla, over the past 4 quarters, roughly 3/4 of its free cash flow is automotive regulatory credits. So the same time you're saying the stock is going to go up and the Trump administration is going to eliminate all of these EV and renewables subsidies, right? Because we put ourselves through these mental gymnastics of picking, we're humans, it's bias, right? Mm-hmm. We find the bias that supports what we think is going to happen instead of constantly poking holes in our thesis, right? We should, if people spent 1/10 as much time trying to poke holes in their investment thesis that they spend trying to confirm why they're going to be right, the average investor would do so much better. Mm-hmm. Just that one little thing, right?
That's a really good point. Yeah, it's very hard to do. It's very easy to be a confirmation bias. I'm going to seek out an opinion that I agree with. It's lower effort. It's easier to do.
Well, it's how we're wired too.
Yeah.
It's you're going against most people's very human nature. You mix investing and politics and confirmation bias, and it's amazingly destructive where your brain can take you. No matter whatever your political bent is or who you are as an investor, you start combining those things and your brain is just going to take you places that your portfolio should not go.
I like that. Put that on Twitter. That's a quote.
Yeah. Well, guys, we are actually at an hour.
That was a fun hour, gentlemen.
Yes, it was. Yes. I guess to wrap up then, I'm going to give you guys an opportunity to tell us where people can find you. And we'll wrap it up.
Well, Jason and I host the Investing Unscripted podcast, which is basically it's kind of like this. We just have conversations about investing. We try to make it sound like if you ran into your one friend who likes to talk about stocks at a bar and you just started talking about stocks, like that's what we're trying to replicate. Not all of us have people in our lives that want to talk about this stuff with us. So you can join in on the conversation with us and hear us kick some of these things around. New episodes for our podcast drop every Wednesday, and then sometimes there's some other bonus content we pop in there as well. We do a live show on the first Friday, or sometimes the second Friday.
Occasionally,
of every month.
First Friday. We call it First Fridays.
Yeah,
but-
I was going to say every Friday, really?
So yeah, it's called First Fridays, and we try to do it then, but doesn't always work out. People travel and things like that. But yeah,
People
anywhere you
meeting,
find podcasts, our YouTube channel, you can go to investingunscripted.com. We have a newsletter. But yeah, we're pretty easy to find. And if you enjoyed this conversation, you should check out the podcast.
Yeah, and it's one thing, Dave, Andrew, you guys are pretty good at helping people understand tools and terms and like really getting into kind of the nuance of investing. We're about the feels. I mean, we really are largely, and I think that's something a lot of people need help with. So I think our two shows I think complement one another really, really well. So would love to have some of your listeners come find us, and need to have you guys back on our podcast too, and let some of our listeners find you guys too. We have stuff on social too. Basically, go to whatever your social flavor is and search for Investing Unscripted. You can find us on social media there too.
Yeah, it's all well worth it. Jeff and Jason are two of my favorite people on the investing world, and they're a lot of fun, and they're also kind of smart. And as you just experienced over the last hour, they have a lot of great insights, and I agree 100%. The feels are very important, and I think you have to combine both. So these guys are a great show, and I would highly, highly encourage you guys, if you don't already listen to it. It's well worth your time, even on Fridays. And so with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.